I think you have to look at the huge change that took place in the early 90s, particularly with the repeal of the Glass-Steagall Act, which took the wall down between investment banking and commercial banking. In the past, when you would make a loan to someone for a home, you would intend to make the loan and collect the payments off that loan, and that would be your customer for a long period of time. So you had a long-term interest in that loan.
In other words, I'm a community bank. I'm the credit union. I'm the guy down the street that you're going to see. I'm going to loan you the money every week or every month. You're going to come by my office, drop me a check, and we'll get to know each other.
Right, because people held the loans then. Then when investment banks and commercial banks could be one, and then when you look at your quarterly reports, well, if you can generate large amounts of fee income by packaging up loans and selling them for a fee and moving that to your income statement, you're going to report greater earnings, your stock price is going to go up, your shareholders are going to be happier, etc. And that's what happened that I think affected this more than anything else, is when you were actually able to sell a currency that didn't exist before because of the separation between investment banking and commercial banking. Then all of the securitization took place, and all of these products began to be bundled together and sold. And they were sold not having in mind the fact that you were going to continue that relationship with that borrower. It was to make that fee income and move it on out.
What do you mean? So I would get a loan from you, but you could sell that loan. And
I would sell that loan, yeah.
Why do they sell loans? I've never quite understood that. I get a new loan, and I have that company as my loan for a good week and a half before they sell it. What's the deal?
Well, Tom could address this better than me, but it's a commodity that they can package and sell for a profit. So they break into little tranches, little units of your loan. Your loan goes in with somebody else's loan, and parts of your loan might be sold off to different people too. And they could end up worldwide. It could end up somebody in Dubai buying your loan. You don't know where it's gone anymore. And the person who is servicing your loan isn't necessarily the investor who owns it. You got a loan from Countrywide. If you think, well, Countrywide owns my loan. Well, maybe not. Maybe Countrywide took that loan and packaged it with 1,000 other loans like you and sold off to somebody. So it was crazy. But although I think when they first started doing it, people thought this is a way to reduce risk. This is great because now all of a sudden we're packaging things together. We can package risky loans with grade A loans. So it's going to mitigate the risk in the risky ones.
Countywide or Countrywide could say, all right, I'm taking all these loans. Most of them are really good. There might be a couple eggs in there, but we'll sell them all off. And your risk is you're buying all these, so you don't have to go through each loan. You just kind of take it as a package deal. Was that good? Was that bad? Why?
Well, it wasn't an all bad thing because what it did was it created all kinds of new capital that didn't exist in the past for mortgage lending, for lending on residential properties. The way you got that money was through a savings and loan or a bank. And so how do they get their money? Well, they get it from the Fed window. They get it from deposits primarily, and they turn around and relend that. Well, that couldn't accommodate all of the kinds of lending that took place because you needed new sources of capital. So therefore, new instruments were created to generate that capital.
Stop there. Let me see if I'm following you. So back when I went down to my good neighborhood bank, they got their money because people like me would put their money in there for their checking accounts and savings accounts. They would use that as a collateral, maybe go to the Fed and try to get some more money, or go to a big bank.
It's a wonderful life, Jimmy Stewart.
Yeah. Exactly. All right. So they're there and say, but Tom, your money's not there. It's in Harry's home. Which, Harry, what are you doing with my money? All right. By bundling it, how did that get more money into the system? That's the part I'm not understanding.
Because it was able to be broken apart and sold as securitizations like a stock. And so therefore, a whole new class, a whole new type of investor came into the market because they could buy this kind of an investment, which was different and provided a better return and a better yield to the investor than simply putting it into a passbook savings or a CD in a commercial bank. And so that opened up a huge amount of money.
So it really became like a financial product. It was almost like a mutual fund.
Yes.
All right.
Yeah.
So it was,
and it wasn't entirely a bad thing. But just like lots of things in life, too much of a good thing can end up getting you in trouble.
Too much of a good thing is just about right. All right, let's bring it back to Colorado. So now that this bubble has burst, Colorado's always had very high residential rates. I mean, it's been a tough market. And it's one of those things because of urban growth boundaries. People aren't allowed to build out new homes. It's tougher for younger couples who are starting out. When the market goes down, people who have a lot of assets, they get hurt. But there's also a plus side. It means that younger people who couldn't afford to get into a home now can get into a home. Just as you got into a home, you said back in the 80s that now was worth quite a bit. Now other people get it. Where are we in that cycle? How does Colorado fare compared to other states, other countries?
Without a doubt, we're better off in other states and in other cities like Las Vegas. During the last few years, Las Vegas and Phoenix saw astronomical growth in their housing prices, and we didn't. And we started this downturn faster. We started having problems before other cities were having problems. And we're probably going to come out faster in other cities right now. For example, last week I called the 7 public trustee offices in the metro area, and they're the ones who process the foreclosures. And in the first 6 months of this year, there have been about just under 11,000 foreclosure filings, and that's down about 10.5% from the first 6 months of last year. Now, part of that is because Chase and Wells Fargo and the other big boys, they had moratoriums on doing new foreclosures. And then from May to June, just looking at the 1 month period, they're actually up 15.5% from in that 1 month period, which might be an indication there's another shoe to fall. First, the moratoriums have ended from the banks that are voluntarily stopped doing foreclosures. And the other thing is, more people are losing their jobs. And before, a lot of people were losing their homes because, the homes were over leveraged. The loans in their homes are worth more than their homes were. Let
me see if
and now they're losing their homes because, or I think it's going to happen more and more in the future.
Right, so the first hit on the housing market was because of these products we were talking about, and people who were over leveraged, they decided to get the interest only loan or to get the high.
Well, they adjusted upwards. That's the problem.
They adjusted upwards, and they can no longer afford the new payments, and there were a lot of foreclosures. That's a problem. But a lot of it was that these people took on loans that they should not have taken on.
Yeah, I think there's a certain amount of responsibility of people. Maybe they understand their product, but if you're buying a house, you should probably look and see what you're signing, because a loan is really an IOU to somebody. You're going to pay back. You should
But who doesn't? I mean, you've gone through these closings. You have to sign 1 million papers. You have to sign disclosures that say you understand the disclosure you just read. I mean, I can't imagine anybody buying a home and not understanding that this is an interest-only loan, or this is an ARM loan, or there will be a balloon payment afterwards. I can't imagine. Colorado has a lot of regulations to make sure people know this thing. But you're suggesting that there might be a second wave of foreclosures, not because people took on too much debt, but because people don't have jobs.
Right, and because our savings rate isn't great in this country. A lot of people don't have. Even people with, let's say, the old DINKs, double income, no kids. They don't have a huge amount saved up usually as a cushion. So I think if people lose their jobs, and they were over leveraged, and if they're unable to refinance, which is much more difficult now than it was a few years ago when all you need was a pulse to get a loan. It's very likely is going to mean another wave of foreclosures, I think.